This conversation is about the importance of long-term capital. What does it mean to be a long-term investor? I can think of few people as credible on this subject as the man sitting to my left. Mark Wiseman, in addition to the role that he occupies currently at BlackRock, is the co-founder and chairman of Focusing Capital on the Long Term, otherwise known as FCLT Global. He lives and breathes this stuff. He's a member of Canadian Finance Minister Bill Morneau's Advisory Council on Economic Growth. So he understands and spends time thinking about the relationship between long-term capital and the performance of the economy. And before taking his current role at BlackRock, he ran one of the world's largest real money investment operations, the Canada Pension Plan Investment Board. Mark, here's where I'd like to begin. Most of the world's capital is long-term in nature. 401ks, retirement nest eggs, pension plans, endowments, family offices, other pools of multi-generational wealth, central bank reserves, and of course, sovereign wealth funds. So if indeed the capital is long-term in nature, why do the incentives in finance overwhelmingly favor and reward short-term performance and liquidity?
Well, first of all, I'm not sure. Thank you, by the way. I'm delighted. I'm delighted to be here, and thank you for the kind words and a little bit of pressure. First of all, what I would say is I just the last part of your premise, I'd take a little bit of have a little bit of a problem with, in that I actually think that long-term capital is rewarded. Most of us aren't patient enough to see it rewarded. But as the previous speaker said, there is definitely a role for long-term capital, and that long-term capital, by and large, and we've seen this in the way that the returns have accrued to sovereign wealth funds. We've seen this in the way that returns have accrued to my former firm. That if patience does pay off for those who wait. But you're right. I mean, financial markets are very fast twitch, and something happens. Something is happening in that value chain. When I think about the value chain, as you said, actually all capital in the world, I think, is pretty much is long-term, because capital by definition belongs to savers, right? And people save. Why do people save? They save for the future. You save to buy a house, you save to put your kids in school, you save for your retirement, you save for future generations of your family, etc. And all of that capital that is saved in the world and is then invested ultimately belongs to individuals. Even the money of a sovereign wealth fund like Mubadala belongs to the people of Abu Dhabi, who are putting it away through the fund for future generations. So what happens? The question is, what happens as we move that money through the system from asset owners like pension funds and sovereign wealth funds to asset managers like BlackRock? Asset managers then allocate that money to corporations who are governed by boards, run by executives, and then they make a capital allocation decision. And if all goes well, ultimately that capital has some return and it flows back to the saver. So the saver's long-term at one end of the chain. At the other end of the chain, what we witness is very short-term decisions made by corporations, I think, as you rightly state. And I think at Focusing Capital in the long term, the research that we've done shows there's a lot that goes on in terms of causing those behaviors, but there's two important pieces in that chain in particular. The first is the nature of the contracting relationship between the asset owner, the pension fund or the sovereign wealth fund, and the asset manager. And that tends to incent shorter term behavior by the asset manager. And then also the other point is that relationship between a board of directors and the management of a company, where again, something's happening there where we're seeing the shareholder having a very long-term view, but in fact, management often making very short-term decisions. So those are the two places where I think we have to put a lot of focus.
What percentage of public company CEOs do you believe truly have the freedom to manage and or invest for the long term?
Well, look, I think the reality is that in a public company, and you and your colleagues at Bloomberg and your competitors are part of this. I mean, you are under constant pressure, under constant scrutiny, day in and day out, to perform. And if your stock is down, there's questions asked. You're on the news. Your shareholders are by definition selling. Your board might be asking questions, et cetera. So there is this pressure put on public company executives to meet certain short-term targets. And I think, I think at the end of the day, one of the things we have to do is find more ways to encourage corporations to take a longer-term view and really focus on creating shareholder value, not I used to say at CPPIB that for us, running a multi-generational pension plan, that a quarter wasn't 90 days, it was 25 years. And so we need our corporate leaders, I believe, to start thinking that way. And we need to be looking at a system which doesn't allow them to do that. Because I think if you ask them, most of them would rather run their business for a much longer duration, and they believe that if they were able to do so, they'd be able to generate more value.
So bit by bit, somewhat obviously, we get to this question of how, right? Do we change the incentives? As you know, and as many people in this audience know, just about a year ago to the day, in fact, Jamie Dimon and Warren Buffett together penned an op-ed in which they proposed what they described as a partial solution, which was ending quarterly earnings guidance. And there are some other people who want to end quarterly earnings altogether and move to annual reporting, or perhaps a reporting schedule that's even longer term than 12 months. The natural, I think, retort to that is less transparency really the solution here?
Well, I think you're absolutely right, Eric, which is that it's easy to conflate less transparency with more long-termism, and I think that's an error. We were involved in some of the work with Jamie and Warren on ending quarterly guidance, and in fact, FCLT did a lot of the research that backs that up. So quarterly guidance, which is companies in between the earnings cycle, this is not about a change in material information where you have to file an 8K. This is about giving just the street, whomever that happens to be, some sort of an indication about how your quarter is doing. And we would advocate that there's no benefit to markets of doing that. We do think, though, that getting rid of quarterly reporting would be a problem because, again, you're conflating transparency with what's causing short-term behaviors. And if anything, we think markets and companies need to be more transparent, including more transparent about their long-term strategy, more transparent about the impact of that long-term strategy or on their strategy on things like environmental, social, and governance factors. So we think, if anything, corporations need to give better and more information, particularly non-financial information, to allow investors to make an appropriate long-term decision. So it's not about having less transparency isn't going to solve the problem. But quarterly guidance serves no real purpose.
Now, it's not an easy seat to occupy, that of the public company's CEO. And if I could just assume his or her position for a moment, how do I reconcile the advantages and perhaps the need for a long-term perspective with the realities of the situation I face? Namely, if I make a decision that the market, the street, doesn't like, my stock might get shorted, right? Activists might wage a proxy fight to oust my board and get rid of me. Some acquirer comes along with an opportunistic offer that my shareholders can't turn down, even if I believe that it is grossly undervalued. How do I reconcile those things?
Well, look, I think public company CEOs are in a very difficult position, as are their boards. Some of that can be combated by better communication, communicating your long-term strategy, being very clear about what it is you're trying to achieve. One well-known sort of Fortune 50 CEO told me, he said, I could maximize my company's share price by cutting R&D back almost to zero. And if I did that, I'd have higher EBITDA margin, higher earnings, I get paid a bigger bonus, and my company would cease to exist in 10 years because over 2/3 of our products were developed in the last 10 years, and we'll have no products for the market in a decade. So I think it's critically important that that CEOs are able to actually put a lot of that noise aside. Now, I believe that one of the big issues is that shareholders, especially long-term shareholders, have to take some responsibility.
They need to be more vocal.
To act like owners, and take more notice of things like governance, and to cause the companies that they own to act in their long-term interest. I believe that activists are a symptom, not the problem. And so why can an activist force a corporation to take short-term decisions if the activist only owns 2 or 3% of the company's register? They can do that because I believe other long-term shareholders, the vast majority of the register is long-term, aren't paying enough attention to their own interests. And so it's one of the reasons, and I'll speak our own book a little bit at BlackRock, it's one of the reasons that last year, 2018, we made such a large push to enhance and grow our corporate governance team, our investment stewardship team, because we own a lot of companies on a lot of shares on behalf of our clients. And interestingly, if you're an index or ETF manager, you're the ultimate long-term holder because you have to replicate the index, so you can't sell the shares. So your only way that you can help your clients increase the value of what they own is by engaging with the companies and encouraging them to take better long-term decisions. So we're doing that, and we think other major long-term institutional investors, be it an ETF provider, a sovereign wealth fund, a pension fund, et cetera, also have to get more involved in the governance of the companies that they own. That
is the source of some philosophical debate in the investment community. Is the agent, right, the investment manager in this case, the ETF manager, the right person to ultimately exercise that responsibility? Some people would say that passive is passive. Active governance is not passive stewardship. How do you answer that?
Well, we're not I don't believe there's any such thing as a passive investor. The reality is that if you're an investor, every decision you make is an active decision. Your decision to buy an index or an ETF is an active decision. Which index you buy is an active decision. The decision to put your money under your mattress or on a coffee can on your shelf is an active decision. So this whole idea of some form of passive investment is nonsense. The reality is every investor, be it the smallest retail investor to the largest sovereign wealth fund, is making decisions day in and day out in order to try and construct a portfolio that will best deliver on their investment objectives. And so whether you're an ETF provider, whether you're providing index services to your clients, or whether you're holding a security directly, either as a principal or an agent, you have a fiduciary duty to maximize the value in the long run of the things that you own. And I think that's critical. And I think otherwise, if we don't do that, who is left to ensure the interest of the owners?
Let's take for a moment.
The answer is the activists,
Right.
right? So you think
They'll step into that void.
You think we've got a problem. You think we've got a problem now, and I'm not sure it's a problem, but you think we've got an issue now. Just wait if no one else shows up to vote.
I was going to say, let's take what we've been talking about, which is largely what goes on in public markets, public equities, and stand it in opposition to private markets and private equity financing. Am I wrong in thinking, Mark, that the kind of governance, the management that you are implicitly advocating is more compatible with private capital than it is with public capital?
So I think there's a lot to be taken from the way that privately owned businesses or private equity-backed businesses, for example, govern themselves. And my belief is actually that public markets need to behave more that way in the way that they are governed. And in fact,
Public markets need to behave more like private markets.
they have to behave more like private markets. And I'll come to a couple examples. But there's a reason, I believe, why it is that today we have half the number of public companies in the United States, about 4,000, than we had in 1988, where we had somewhere around 8,000 public companies. And part of that is because, not entirely, but a good part of that is because there's more private companies, there's larger private companies, they're able to stay private for a longer period of time. And indeed, the evidence would indicate quite clearly that over that long-term period, they've outperformed. So why have they outperformed? Well, some of the research that McKinsey has done and FCLT and Global has done shows things like the amount of time that private company boards spend forward-looking, talking about long-term strategy, as compared to a public company board, which has to spend a lot of its time looking through the rearview mirror. Think about your annual report. Think about your compliance, everything else. All of that is talking about what's happened in the past. We would suggest that companies and their boards need to spend a lot more time talking about what needs to happen in the future. And that probably means, that doesn't mean that they should necessarily not do things like spend time in their audited financial statements, but it means that boards, for example, need to probably meet more often, like a private company board. They need to get more involved in the forward strategy of the firms that they govern. Probably board members, on average, need to be on less boards and need to be more involved. And these are all the things that we see private companies doing more of, and making more and more decisions that maximize long-term value. And by the way, just if anybody's a little bit bored, there's actually a great article written about this in 1989 by Michael Jensen in the Harvard Business Review, called The Eclipse of the Public Corporation. And he basically made the same argument I just made. And yet, I don't think anyone's read it, because since he wrote it, there's about 4,000 public companies that have disappeared. But the reality is that we need to reduce that agency cost that exists between the owner and the company that they own and the management of the company that they own, and get a greater degree of alignment. And private companies, just simply that chain, that agency chain, is much shorter in a private company. We can replicate, I believe, more of that in the public markets.
You mentioned private equity. There's obviously a big difference between the kind of outlook and, to some degree, approach to investing that a firm like Mubadala takes relative to what I could name any private equity firm takes. And I feel I've always felt that it's my duty as the moderator to channel the cynicism in the room. And it feels to me like the cynicism in the room wonders whether private equity takes long-termism seriously, or whether it's just parroting the language of long-termism because that's what it believes its LPs want to hear.
Well, look, private equity has been a fantastic model for a long period of time, and it will continue to deliver value to investors. The reality is that it's imperfect. It's good, but imperfect. And it's imperfect in part because as that market, like all markets, has become more efficient, the traditional 2 and 20 model has put the market in a position, or has put the investor, the LP, in a position where more and more of the economic rent is captured by the general partner. And by the way, that's no different than what we've seen happen with active public equity managers, with credit managers, et cetera, et cetera. As markets have become more efficient, there's had to be a change in the economic incentives in that contract between the asset owner and the asset manager. So I would argue that something has to change in the private equity world. We're at BlackRock taking advantage of that with a new vehicle that we've launched called LongTerm Private Capital, which seeks to create a better alignment of interest between the investor and the manager and ultimately the portfolio company. I don't know if what we're proposing, the market seems to think it's pretty good, but I don't know if what we're proposing is perfect, but it's certainly an improvement on that alignment than traditional private equity. So yes, public markets need to look more like private equity, and maybe private equity needs to look more like Mubadala, et cetera, et cetera. And all of this can be, I think, improved over time. And by the way, that's what financial innovation is all about.
What's your experience been like so far raising this slightly differentiated, or maybe more than slightly differentiated, pool of long-term capital for private equity?
Well, look, innovation is hard. Innovation is hard in any market. So for those of you who don't know, on March the 30th, we launched long-term private capital at BlackRock with an initial investment of a series of cornerstone investors for $2.75 billion. And it's been hard to explain a new model, a model that's sort of more of a permanent capital structure, but private in nature. But having said that, I think sophisticated investors sort of have understood it, and we're now seeing a lot of interest in the vehicle, both from investors and, by the way, recipients of capital who themselves are looking for longer-term sources of governance and longer-term sources of capital because they want to be able to fulfill their long-term strategic ambitions. And in many respects, this is what CPPIB has done. It's what Mubadala has done. It's what other long-term investors have done. And what we're trying to do at some degree is make that type of investing available to those institutions and ultimately others who don't necessarily have the means themselves to build the type of capabilities that the big sovereigns and pension funds have been able to do.
Are long-termism and sustainability the same thing?
I think that's a great question. And the answer is yes. And the answer is yes because in the long run, and this is one of the reasons that I think this is so important, in the long run, value and values converge. So as you get more long-term in your thinking, things like environmental, social, and governance factors in the companies you invest in become more important. And so whilst you might have a values-based decision, you want to invest in a certain way or in certain types of companies or in certain types of products because you think it's the right thing to do, that's a values-based decision. As you get more long-term, it also becomes a value decision. And I'll give you just the easiest explanation I could think of, which is imagine you're buying a warehouse down in Manhattan here on South Street. And it's built right by the water. If you plan to own that warehouse for 5 years, you probably don't give a damn about climate change. If you plan to own that warehouse for 25 years or 50 years, you better give a damn about rising sea levels, because your investment ain't going to be worth much when it's 10 feet underwater. And so as you get more long-term in your thinking, these factors become critical to your valuation. And so I think one of the big benefits of having a longer-term perspective is that ESG and other related inputs don't just be, it's not just about doing the right thing. And by the way, I happen to think it's also the right thing, but it actually goes to the essence of what your investment thesis is.
So with that, examples are obviously worth 1,000 words or more. The reality, of course, is that when confronted with these kinds of challenges, people don't have a ready, book of examples to draw from. They're forced, to deal with the alphabet soup of acronyms, right? ESG, CSR, inclusive capitalism, impact investing, investing with purpose. If you ask 10 investment professionals or 10 corporate directors what those things mean, those 5 things mean, you could get 50 different answers. Right. So how do the royal we keep long-term investing from being like shopping for food? And what I mean by that is if you go out and buy organic, you buy it because it sounds good, feels right, even though the reality is that the labeling standards are so vague as to be virtually meaningless.
So we have to do more, and there's a lot of groups working on this. And look, this is a little bit like the time before GAP, right? Where there wasn't necessarily
agreement.
That's GAP with 2 A's.
No, agreement on a set of standards.
There was an agreement on a set of standards, and not like the clothing guys. So the reality is it's going to take time for this to coalesce. And what you're seeing out there, I think, and this is as it relates to non-financial information, you're seeing varied standards being proposed, whether it's the work that Bob Eccles is doing, whether it's work that the IRC is doing with Dominic Barton is leading, and a multitude of other efforts. So this will eventually come together. Now, the good news in all of this is that in a world of big data and AI, at some level, that standard setting is less important. And it's less important because it's easier and cheaper to go direct to source data to be able to find the information that you want. So for instance, if you wanted to, you could have, I think it would be great if companies did a better job reporting on their health and safety in terms of the environment that their workers operate in. And we know that companies that do a better job with health and safety actually tend to outperform in the long run. We know that empirically. So we could wait until some body decides on some standardized principle for how that should be reported, or because health and safety violations are a matter of public record in the United States, and those public records are available on the World Wide Web, we can now build algorithms that can find out that information and assist us using big data and AI in assessing the quality of the health and safety of any public corporations.
Is BlackRock doing that kind of thing?
We are absolutely doing that type of thing. And we're doing it because we believe that it goes to value. So we're doing that in 2 ways. We're doing that in what we do for our what we call our systematic investing, where we're making investment decisions based on algorithms and signals, but we're also increasingly arming our fundamental investors with new arrows in their quiver that go beyond traditional metrics.
So So outside, say, occupational health and safety, what kinds of things what kinds of data sets are you looking for? What do you find useful?
So it changes all the time, and we're constantly looking for new data sets. And by the way, these data sets sometimes are valuable for a while and they become less valuable. But we're using everything from satellite imagery to sophisticated mapping data that tracks. I'm doing this because my mobile phone's here. That tracks mobile phone movement, to looking at data from social media. But we are today purchasing literally hundreds of sets of data, both structured and unstructured, that we are using to inform our investments decisions. Some of those may relate to things like ESG topics. And some of them are more pedestrian in terms of what they are. But this is today, as the world moves to digitize and to democratize information. And by the way, there's a little company that's made a business out of this called Bloomberg. As more and more as information becomes democratized, this is going to allow this type of information, which is data analytics applied to it to create information, to be used by investors to make decisions. So it'd be great if we get standards set and we get more consistent reporting on some of these non-financial metrics. I think that will come. But the interesting thing is, even if it doesn't, we're going to figure out a way to get that information anyway.
Mark, together we've kept people waiting long enough to eat. So I'm going to finish with this question, if I may. It feels sustainability, this discussion around long-termism feels very much of the moment. What's the chance that 5 years from now, we'll look back on this as a fad, and the new refrain will be the old refrain, just show me the quarterly EPS?
I think there's zero chance of that happening. I think there's zero chance of that happening because, first of all, people are starting to realize that values and value are converging. Secondly, investors are demanding it. I will tell you that any institutional asset manager today, be it BlackRock or any one of our competitors, will not win any RFP for any type of investment activity unless we can explain how we are integrating ESG into our investment decision-making processes. So
it's table stakes.
So A, it actually does go to value. B, our clients are demanding it. And C, individuals, particularly those who are of the millennial age, care about it. For them, having purpose in what they do, in how they spend their money, in what drives their return on investment is as important to them as just pure ROI. So I think for all of those reasons, I mean, we are seeing nothing but an acceleration of this trend and no evidence of it going the other way. And by the way, I think that's a great thing for investors, and I think that's a great thing for society, because ultimately what we want to do is be able to not just create sustainable investments, but create a sustainable planet and a sustainable business environment.